So in today's lesson, we'll be dealing with the cash flow statement. The cash flow statement is a financial statement introduced in grade 12. Alright, so before we do that, let's take a step back, hop back a little into the previous grades. So now, in grade 10, we learned about the income statement, which showed us the net profit or loss of a business for an accounting period. And then we went on to learn about balance sheet, which shows us the financial position of the business. In explanation, shows us what the business is worth. But then none of these two statements that we were taught shows us the details of where we got our cash and where we used up our cash. That's where we introduced the cash flow statement, which shows us the details about the cash received and also the cash paid. So now, this is what you expect to see your cash flow looking like. So basically, this is the format of the cash flow statement. It has four major components, being the cash flows from operating activities. We have the cash flows from investing activities. We have the cash flows from financing activities. And lastly, we have the net cash and cash equivalents. So we're going to be discussing all these. So the cash flow statement, just like any other statement, it has its own notes. So we have note number 1 as the cash generated from operations. We have note number 2 as the net cash and cash equivalent. We have our note number 3 as the dividends paid. Number 4, taxation paid. And the last one, number 5, will be the purchases of fixed assets. So get a hold to this format. We'll be using this format in the next videos. So in the next videos, we'll be explaining in detail on the note and how to prepare the cash flow statement. Now, I'm just going to touch on the first note. The first note, we have the cash generated from operations. The first thing that goes in there is the net profit before tax. Please note this down. This is before tax, not after tax. We have the net profit after tax, but this one is the before tax. All right. Then we're gonna add back the depreciation and also the interest expense to the net profit before tax to get our net profit before changes in working capital. So after the net profit before changes in working capital, obviously we're gonna have the changes in working capital. Working capital is a summary of the change in inventory, the change in trade and other receivables, and also the trade and other payables. All right. So we add those together, we get the changes in working capital. Then we add that with the net profit before changes in working capital to get our cash generated from operations. If that is too much, don't worry, I'm with you. I'm gonna explain this in detail in the next video with an example. Anyway, guys, that's it from me. If you like the video, please like, subscribe, and share our videos. Otherwise, that's my time. Prime out.